In 1989, the British government sold the water industry of England and Wales. 10 regional water authorities, covering every tap and every drain from Northumberland to Cornwall. Before the sale, the government did something that sounds like a technicality and isn't. It wrote off the industry's debts. Every one of those companies began its private life owing nothing at all. By the end of March 2022, the sector carried more than £60 billion of debt. Nobody bombed a treatment works. There was no recession that emptied the reservoirs. Water demand in England is not meaningfully different from what it was in 1989, and the pipes in the ground are mostly the same pipes. Something took an industry with no borrowings and produced one of the most indebted regulated sectors in Europe, and it did it in about 30 years. The story you've heard about this is a story about sewage. Discharges into rivers, warnings not to swim, headlines every summer. That story is real, and we'll get to it, but it is a symptom rather than a cause, and starting there gets the diagnosis wrong. Because the question that actually matters is simpler and stranger. If the company started with nothing and now owes £60 billion, somebody received £60 billion. Where did it go, and what was it for? This is a long story, so let me tell you where we're going. First, what Britain actually sold in 1989, and why the thing being sold was not really the water. Then, how one company in particular was used, over roughly a decade, to demonstrate exactly how much could be taken out of a regulated monopoly. And finally, what happens now that the bill has arrived, and what the whole episode reveals about a mistake that runs much wider than water. Let's start in the 1980s, because you can't understand the sale without understanding what was for sale. By the middle of that decade, the British water system was in trouble, and it had been for a long time. The 10 regional water authorities were public bodies. They were funded through public borrowing and through bills, and both of those were controlled by the Treasury. Through the 1970s and into the 80s, with inflation high and public finances tight, the government limited how much the authorities could borrow and how much they could charge. Day-to-day operating spending held roughly steady. Capital spending, the money that replaces pipes and builds treatment works, fell sharply from the late 70s and stayed low for a decade. That is a very specific kind of decline, and it's worth being precise about it, because it explains everything that followed. You can run a water system on low capital spending for a surprisingly long time. Pipes laid in the Victorian era do not fail the year after you stop maintaining them. They fail slowly, unevenly, and mostly out of sight. So the consequences of underinvestment arrive years after the decision to underinvest, by which time whoever made the decision has moved on. Meanwhile, the bills that come due are getting larger. Britain was, at the time, facing European directives on drinking water quality and on bathing water, and meeting them would require enormous investment in treatment. The estimates ran into tens of billions of pounds. So the government was looking at an industry that needed a vast amount of money it did not want to provide, at a moment when public borrowing was politically toxic. Privatisation solved that problem, and I want to be fair about this, because the case for it was not absurd. Move the industry off the public balance sheet, and its borrowing stops being government borrowing. Private companies could raise money on capital markets without it counting against the public finances. In principle, competition for capital would drive efficiency. In principle, a dedicated regulator could hold prices down better than the Treasury ever had. That was the argument, and it was made in good faith by people who believed it. The Water Act came in 1989. The 10 regional water authorities in England and Wales were converted into companies and floated on the London Stock Exchange. The public was invited to buy shares, and many did. Now, here is the detail that shapes the next 35 years, and it very rarely makes the headlines. The industry did not go to market as it stood. Before the sale, the government wrote off the accumulated debt of the water authorities, and it also provided cash. The arrangement acquired a nickname at the time: the green dowry. Money handed over with the bride to make the marriage attractive. Think about what that means as a commercial proposition. You are being offered a company that owns a regional monopoly on an essential service. It has no debt. It comes with cash. Its customers cannot leave, cannot shop around, and cannot decline to buy the product, because the product is water. There has rarely been a safer asset sold in Britain. And that safety is the thing to hold on to, because everything that happened afterwards follows from it. A business with no competition, no possibility of customer loss, and a legally protected revenue stream is not really an operating company in the ordinary sense. It is closer to a bond. A stream of payments, arriving reliably, from people who have no choice. Which brings us to the part that most explanations skip, and which you genuinely need in order to follow the rest. How a privatized water company is actually regulated. Bear with me for a few minutes, because this is where the mechanism lives. A water company is a monopoly. Nobody is going to lay a second set of pipes down your street to compete for your custom. So the market cannot set the price, because there is no market. Something has to set it instead, and in England and Wales that something is a regulator called Ofwat. Every 5 years, Ofwat conducts a price review. It looks at what each company needs to spend, what it needs to earn, and it sets the maximum it may charge customers over the following 5 years. That's the price control. To do that, the regulator needs to answer one central question. How much money is this company entitled to make? And the answer is built on a concept called the regulated capital value. Think of it as the official valuation of everything the company has invested in its network. The pipes, the treatment works, the reservoirs, the pumping stations, all of it, expressed as a single number. The company is then permitted to earn a return on that number. Not on its profits, not on its cleverness, not on how well it serves anyone. On the value of the assets it holds. Now, if that sounds abstract, here is what it means in practice. The bigger the regulated capital value, the more money the company is allowed to make. And the regulated capital value grows when the company invests. So the system contains a permanent, structural incentive to spend on assets, because spending on assets increases the base on which you are allowed to earn. That's a defensible design. You want a water company to invest, and this rewards it for investing. Fine. But there's a second element, and it is the one that matters most for this story. When the regulator decides how much a company may charge, it has to account for the cost of the company's financing. A company funds itself with a mixture of equity, meaning shareholders' money, and debt, meaning borrowed money. Debt has to be serviced. Interest has to be paid. And the regulator, in setting the price customers pay, includes an allowance for the cost of that financing. Read that again, because it is the hinge of the entire story. The interest on a water company's borrowing is a cost. Costs are reflected in the price control. The price control determines your bill. Which means that when a water company borrows money, the servicing of that borrowing is ultimately funded by customers. Not directly, not line by line, and the regulator sets an allowance based on what an efficiently financed company should pay rather than simply passing through whatever any particular company has agreed. But structurally, in a regulated monopoly, the cost of debt lands in the tariff. So now put the pieces together and look at what kind of machine you have built. You have a company with a guaranteed customer base that cannot leave. It earns a regulated return on the value of its assets. Its financing costs are recognized in the price it is allowed to charge. and it has no competitor who might undercut it. If you borrow money against that, you are borrowing against one of the most predictable income streams in the British economy. Lenders know this. That is precisely why they will lend a great deal, at good rates, to a water company. And if you borrow money and then pay that money out to your shareholders as a dividend, you have converted a future stream of customer payments into cash in hand today. The debt stays with the company. The cash leaves. Nothing about that is illegal. Companies borrow and pay dividends every day, across every sector. In a competitive industry, it is also risky because if trade turns down, you still owe the money and your customers can go elsewhere. In a regulated water monopoly, that risk is very much smaller because the customers cannot go elsewhere. There is no bad quarter in which people stop needing water. So the ordinary discipline that stops a company loading itself with debt is largely absent, and what remains is a structure where borrowing heavily is not reckless. It's rational. Now, at this point you might reasonably ask why the regulator would permit that. And the honest answer is that for a long stretch, it broadly did. Ofwat's principal statutory concern was that companies could finance their functions and keep the water flowing. A highly indebted company that was still meeting its obligations was not obviously failing that test. Gearing, the proportion of the business funded by borrowing rather than equity, was monitored, but for years it drifted upward across the sector without meaningful intervention. And there's a deeper reason it was hard to stop, which is worth sitting with. If the regulator sets prices on the assumption that a company is financed in a sensible way, and a company then finances itself far more aggressively than that, the extra return generated by the aggressive financing flows to the shareholders. The regulator has priced for a notional company. The actual company is doing something else. The gap between the two is profit. That is not a loophole somebody discovered. It's an inherent feature of setting prices for an idealized firm and then allowing real firms to organize themselves however they like. So that is the machine as it existed by the mid-1990s. 10 monopolies, sold debt-free, guaranteed customers, a regulated return on assets, and a financing structure the owners could design themselves. For the first decade or so, the results were genuinely mixed rather than disastrous. Investment did rise sharply after privatisation, and it had to, because of the European quality directives. Drinking water quality improved. Bathing water improved. Anyone telling you privatisation delivered nothing is not being straight with you. But at the same time, a pattern was establishing itself. Money was going in the form of investment, and money was coming out, in the form of dividends, and the second number was becoming very large. Here is the shape of it across the whole period, from research by the Financial Times based on regulatory data and adjusted for inflation. Between privatisation and March 2023, the water monopolies of England and Wales paid out around £78 billion in dividends. Over the same 3 decades, they spent about £190 billion on infrastructure. £78 billion out to shareholders. £190 billion into the network. The dividends came to close to half of everything that was invested. And across that same period, companies that had been sold with no borrowings at all accumulated more than £64 billion of net debt. Now, I want to be careful about how those numbers are read, because it would be easy to overstate them and I'd rather not. Dividends are not theft. Shareholders provided capital and are entitled to a return, and some of the companies genuinely did raise equity and invest it. 30 years is a long time, and £78 billion spread across 16 monopolies over 3 decades is a smaller annual figure than the headline suggests. Debt is not automatically bad either. Infrastructure is long-lived, and borrowing against assets that will serve customers for a century is a reasonable way to fund them. So the case against is not that dividends were paid or that debt was taken on. It is narrower and much harder to answer. It is that companies handed over with zero debt, holding permanent monopolies over an essential service, ended up with £64 billion of borrowing, and that a very large share of what that borrowing bought was not pipes. That's the sector. Now I want to look at one company in detail, because one company took this structure and demonstrated, over about a decade, precisely how far it could be pushed. Thames Water serves roughly 15 million people. London and much of the surrounding southeast. It is the largest water company in the country by a wide margin, and its network includes some of the oldest infrastructure in Britain, in the most expensive place in Britain to dig a hole. It was floated in 1989 like the rest. In 2001 it was bought by RWE, a German power company, which held it for 5 years and then decided the returns were not what it wanted and put it back on the market. And in 2006 it was acquired by a consortium led by Macquarie, an Australian investment bank, through a holding company called Thames Water. What happened over the following decade is the clearest illustration available anywhere of what the machine we've just described can actually do. Macquarie is an infrastructure investor. That's not a criticism, it's a description of a business model. Firms like it raise money from pension funds and institutions, buy assets that produce long-term, predictable cash flows, and manage those assets to produce returns for the people whose money they raised. Roads, airports, ports, utilities. Things people cannot easily stop using. And a water monopoly is close to the Platonic ideal of that asset class. Its revenue is set by a regulator, protected by law, and paid by customers who have no alternative supplier. If your entire business is finding predictable cash flows and financing them efficiently, a regional water monopoly is almost too good. So when the consortium took control of Thames Water in 2006, it was not buying a water company in the way you might buy a bakery. It was buying an income stream, and it was going to finance that income stream in the way an investment bank finances things. Here is what happened to the balance sheet. When the consortium took over in 2007, Thames Water's debt stood at about £3.2 billion. Over the following decade, it rose to £10.7 billion. The proportion of the business funded by borrowing rose to over 80%. And across that same period, the company paid out dividends of around £2.5 billion. Let those three numbers sit next to each other for a moment. Debt up by roughly £7.5 billion. Gearing above 80%. £2.5 billion paid out to shareholders. Now, the company has said in the past that it operated a strict, performance-linked dividend policy monitored by the regulator, and that should be on the record. And it is genuinely true that some of the borrowing funded investment. Thames Water did build things during this period. The Thames Tideway Tunnel, the enormous sewer under London, was conceived and begun in these years, though it was ultimately financed through a separate vehicle. But look at the direction of travel, because the direction is unmistakable. An asset that had been handed over debt-free in 1989 and still carried only £3 billion of borrowing after 17 years of private ownership, took on another £7.5 billion in 10. And here is the detail that tells you most about what kind of transaction this was. Thames Water received no equity injection from its owners at all, from privatisation right through until 2023. Not during the Macquarie decade, not after it. When money finally did arrive, in 2023, it came as a loan of £515 million at 8% interest, through a structure that recorded it as debt in the regulated company's books. Think about what that means. Across more than 30 years, the owners of Britain's largest water company put in essentially no new equity, while taking out billions in dividends, and the company's investment was funded by borrowing that the customers would ultimately service. When Macquarie sold out in 2017, estimates at the time put its annual rate of return somewhere between 15 and 19%. Over roughly a decade. On a regulated utility with no competitors and no demand risk. That is a spectacular return. And I want to be precise about why it's spectacular, because the reason is the whole point of this film. A return like that is normally the reward for taking a risk. You back a company that might fail, and if it doesn't, you're paid for having been willing to lose your money. That's what equity returns are supposed to compensate you for. But the risk in a regulated water monopoly is unusually low. Customers can't leave. Revenue is legally protected. Demand doesn't collapse in a recession. So where does a 15 to 19% return come from, if not from risk? It comes from leverage. Let me make that concrete, with round numbers rather than the real ones, purely to show the arithmetic. Suppose you buy an asset for £100 using your own money, and it reliably yields £6 a year. Your return is 6% solid, unexciting, roughly what a safe regulated utility should pay. Now suppose instead you put in £20 of your own money and borrow the other 80 at 4% interest. The asset still yields £6. Your interest bill is £3.20. What's left is £2.80 on £20 of your own money. That's 14%. Same asset. Same water. Same pipes. Same customers. The return to the owner has more than doubled, and nothing about the underlying business has changed at all. That is what leverage does, and there is nothing mysterious or improper about it in general. It's ordinary finance, taught in every business school, used in every industry. But notice what it requires, and notice who supplies it. It requires an income stream reliable enough that lenders will fund 80% of the purchase. In a normal company they won't, because a normal company might lose its customers. Here they will, because the customers are captive and the revenue is set by a regulator. So the thing that makes the leverage possible is precisely the thing that made the asset attractive in the first place. The certainty. And the certainty exists because it's water, and because it's a monopoly, and because the state guaranteed it. Which means the return isn't really being generated by the investor's skill. It's being generated by the structure. The investor's contribution is recognizing that the structure allows it. Now add the second element, the one we established earlier. The interest on that borrowing is a cost, and costs feed into the price control, and the price control determines the bill. So the arithmetic completes itself. Leverage magnifies the return to shareholders. The cost of the leverage lands, structurally, in what customers pay. The asset itself is unchanged. And the risk that would normally justify the return was never really there. That is the mechanism at the center of this entire story, and once you can see it, the sector-wide numbers stop looking like a series of unfortunate decisions and start looking like a pattern. Because Thames Water was the extreme case, but it was not the only case. Across England and Wales, the water monopolies took on more than £64 billion of net debt between privatisation and March 2023, having started with none. In the 2 financial years from 2021 alone, they paid £2.5 billion in dividends while adding £8.2 billion to net debt. Read that last sentence carefully. In 2 years, the sector paid out £2.5 billion to shareholders while its borrowings rose by more than 3 times that amount. Now, is that dividends funded by debt? Not in a simple, traceable sense. Money is fungible, companies don't tag pounds, and the companies would say the borrowing funded investment while the dividends came from operating profits. That's a legitimate defense, and I'm not going to pretend it isn't. But at the level of the balance sheet, the aggregate effect is the same regardless of how it's labeled. Cash left the business and went to shareholders. Obligations entered the business and stayed. The customer base that services those obligations is unchanged. And the assets those customers depend on are, by common consent, in worse condition than they should be after 30 years of investment at that scale. There's a comparison worth making here, and it's the cleanest test available, because it removes almost every other variable. Scotland did not privatise its water. Scottish Water is publicly owned. It still borrows money, it still invests in infrastructure, it still charges customers, and it still has to balance the same competing demands as any English company. The difference is that no money leaves the system as dividends. The borrowing is serviced, the investment happens, and what would have been a return to shareholders stays inside the business. I want to be fair about this comparison rather than lean on it too hard. Scotland's geography is different, its population density is different, its capital programme is different, and Scottish Water has had its own performance criticisms. Anyone telling you public ownership is automatically better is skipping a lot of detail. But the structural point survives all of that. In one system, a portion of every bill leaves permanently as a return to private capital. In the other, it doesn't. Over 35 years, that difference compounds into something enormous. Now let's talk about the holding companies, because this is where the structure gets deliberately hard to see. Thames Water, the entity you receive your bill from, is a regulated company. Ofwat supervises it, sets its prices, and imposes conditions on it. That entity sits underneath a chain of holding companies, and in the Macquarie era the chain reached up to Kemble Water Holdings. Why does that matter? Because regulation attaches to the regulated entity. The rules about dividends, about gearing, about cash retention, apply at that level. Above it, the structure is a private matter between the owners. So a group can be organized such that the regulated company looks reasonably capitalized while borrowing sits higher up the chain, serviced by cash passed upward from the operating business. The regulator sees a company meeting its license conditions. The economic reality of the group is something else. Some of these structures involved companies registered in the Cayman Islands. That detail generated a great deal of anger when it emerged, and I understand why, but I want to be accurate about what it does and doesn't mean. Using an offshore vehicle in a financing structure is not in itself evidence of wrongdoing, and it is extremely common in infrastructure finance. What it does mean is opacity. It becomes harder for a customer, a journalist, or a parliamentary committee to see who owns what and where the money goes. And in an industry that is a legal monopoly over an essential service, funded by people who have no choice but to pay, opacity is not a neutral quality. It is a decision about how much the public is allowed to know about a thing it cannot opt out of. So by the late 2010s, this is where the sector stands. Companies handed over debt-free, now carrying more than £60 billion of borrowing. Roughly £78 billion paid out to shareholders across 3 decades, against £190 billion invested. Ownership structures that are difficult to trace. A regulator whose price controls assume a notional efficient company while real companies finance themselves far more aggressively. And an asset base that everybody, by this point, can see is not in the condition it ought to be. And then the bill starts to arrive. Not one bill. Several, all at once. That's the third act, and it's where this stops being a story about finance and becomes a story you can smell from the riverbank. You can smell the third act, which is the reason most people know this story at all. Sewage. Discharges into rivers and onto beaches. Warnings not to swim. Volunteer groups testing water quality because nobody official was doing it often enough. It became, over about 5 years, one of the few subjects in British public life that unites people across every political line. And I want to place it carefully, because the sewage is not the cause of what we've been describing. It's the receipt. When a water company defers investment in its network, the consequence does not appear on the balance sheet. It appears in a river. Storm overflows exist for genuine reasons, to stop sewage backing up into homes when the system is overwhelmed, but a system with adequate capacity uses them rarely. A system running beyond its design capacity uses them constantly. So the discharges are, in a fairly direct sense, the physical form of 30 years of financial decisions. The money that didn't go into capacity went somewhere. What comes out of the overflow is the difference. In May 2025, the regulator imposed a record penalty on Thames Water. £123 million in total. £104.5 million of it for sewage discharges, and £18.2 million for breaching the rules on dividends. Note that second component, because it's the more revealing of the two. The regulator found the company had paid what it described as undeserved dividends to shareholders while its environmental obligations went unmet. And it concluded the company had failed to build, maintain, and operate adequate infrastructure. That is a regulator saying, formally, that money went out of the door which should have gone into the ground. Meanwhile, the financial structure we spent the last half hour describing had begun to come apart, and it came apart quickly. The mechanism that made the debt cheap was low interest rates. For most of the 2010s, borrowing was close to free by historical standards, and a highly geared water company could service enormous debts comfortably. When rates rose sharply, the arithmetic inverted. Debt that had been cheap became expensive, and a business with 80% gearing has very little room to absorb that. In March 2024, Thames Water failed to raise a £500 million cash injection from its shareholders. The following month, Kemble, the holding company above it, defaulted on an interest payment on £400 million of debt. Read that as what it was. The owners were asked to put money in, and declined. The structure above the regulated company stopped paying its bills. By early 2025, the operating company was close to running out of money. Members of Parliament were later told that at one point it had roughly 5 weeks of cash remaining. In March, the High Court approved an emergency facility of up to £3 billion from its own senior creditors, which kept it running. Think about what that means. The company was rescued by the people it owed money to, because those creditors preferred a functioning debtor to a collapsed one. Then came an attempted sale. A large American private equity firm was named preferred bidder to recapitalize the business, and in June 2025 it walked away without making an offer, which left the creditors themselves as the only remaining buyers. A consortium of bondholders, including some of the largest distressed debt investors in the world, proposed taking control directly. Their plan involved injecting new equity of around £3.35 billion and providing further debt, alongside writing down a substantial portion of what they themselves were owed. At the time this was made, Thames Water served around 16 million people and carried close to £20 billion of debt. And running alongside all of this is the option nobody in government wants to use, which is worth explaining properly because it's the thing everything else is being measured against. It's called the Special Administration Regime. It exists precisely because you cannot allow a water company to simply fail. If a normal company collapses, its customers go elsewhere. If a water company collapses, 16 million people still need water tomorrow morning. So the law provides for the state to step in, appoint an administrator, and run the company in the public interest until it can be transferred or restructured. It is not nationalization in the ordinary sense. It's a temporary custodianship with a specific job. The bar for using it has always been described as very high, and for a long time the company insisted it was nowhere near that bar. By 2026, the government had openly stepped up its preparations for it, and the company's own annual report acknowledged special administration as a real possibility whether a deal happened or not. I should be straight with you about the status of all this, because it is genuinely live. As this was written, in late July 2026, the outcome had not been settled. A creditor-led rescue was on the table, including an offer to give the government a golden share carrying veto powers over major decisions, and a commitment to suspend dividends for at least a decade. Temporary public control was under active consideration. Whichever way it has gone by the time you watch this, check the current position, because it will have moved. There's one more piece of the picture that matters, and it isn't about Thames Water at all. In July 2025, an independent commission reported on the state of the water sector as a whole. Its conclusion included the recommendation that Ofwat, the economic regulator created at privatisation, should be abolished. That is an extraordinary thing for a review to conclude. Not reformed. Not given new powers. Abolished, and replaced. And it matters for how you read everything we've covered, because it's an admission at the highest level that the failure was not confined to one badly run company. If the problem were one firm, you'd punish the firm. Abolishing the referee is what you do when you've decided the rules were wrong. So here's where the whole thing turns over. Everything up to now invites a story about villains. An investment bank that stripped an asset. Executives who took bonuses while rivers filled with sewage. A regulator asleep at the wheel. That story is available, it's popular, and parts of it are true. But it doesn't survive the arithmetic, and here's why. If this were about a few bad actors, you would expect the pattern to be exceptional. One company, or two, behaving unusually. What you actually find is the entire sector doing versions of the same thing over 3 decades, under different owners, different management teams and different governments. 10 companies became 16. Ownership passed through stock market investors, foreign utilities, infrastructure funds, sovereign wealth funds and pension schemes. And through every one of those hands, the same thing happened. Debt rose. Dividends flowed. Investment lagged. When every participant in a system behaves the same way regardless of who they are, you're not looking at character. You're looking at design. So here's the framing I'd offer instead. What Britain sold in 1989 was not really a water industry. It was a claim on the future payments of a captive population, wrapped in a set of pipes. That's not a rhetorical flourish, it's a description of the asset. The pipes themselves generate no return. What generates the return is the legal right to bill 16 million people who cannot refuse, for a product they cannot obtain elsewhere, at a price set by a regulator who must allow the company to finance itself. And an asset like that has a very particular property. It can be borrowed against, heavily, because the income is certain. Which means its value to an owner is not primarily what it produces. It's how much can be raised against it. Once you see it that way, the £60 billion of debt stops looking like a failure of the model and starts looking like the model working exactly as its incentives demanded. Nobody had to conspire. Each owner in turn looked at a monopoly with guaranteed revenue, observed that lenders would fund it cheaply, and did the rational thing. The debt is not evidence that something went wrong. It is what the asset was converted into. And here is the sharpest version of it. The government in 1989 wrote off the industry's debt so the companies could be sold clean. 35 years later the industry is carrying more debt than it ever did in public ownership. The state took the borrowing off the public books, and the borrowing came back, larger, on terms the public did not set and cannot see, secured against the same customers who were the security in the first place. That's the trade that was actually made. Not public to private. Visible to invisible. Which raises the obvious question, and I don't think it has a comfortable answer. What now? Take it back into public ownership, and you have to deal with the regulated capital value, that official valuation of the network we discussed earlier. Any compensation to owners is argued around that number, and it is very large. Buying the sector back at anything close to it means the public paying, again, for assets it built, sold, and has been paying for through bills ever since. Alternatively, let the creditors take control and impose losses on themselves. That has a certain justice to it, since lenders who financed an over-leveraged structure arguably ought to bear the consequences. But those creditors include pension funds and insurers, which is to say ordinary people's retirement money, and they will want a return, which means the extraction question doesn't disappear. It changes hands. Or use special administration, restructure the debt under public control, and transfer the business on. That's the option that has been circling for 2 years, and the reason it keeps not happening is that nobody in government wants to own the consequences of a decision this large. There is no clean exit, and that's not a failure of imagination by the current lot. It's the position the country was maneuvered into over 35 years, one reasonable-looking decision at a time. Which brings me to what I think this is actually about, because it isn't only about water. The lesson usually drawn from all this is that privatisation was a mistake. I don't think that's quite right, and I don't think it's the useful version. Plenty of privatised industries have worked reasonably. Telecoms had genuine competition, and prices fell. Airlines had genuine competition. Where a market can actually exist, private ownership does a lot of what its advocates promised. The specific error was privatizing something that could not have a market. Nobody was ever going to lay a second water network. There was never going to be a competitor. So the discipline that makes private ownership work, the possibility of losing customers to somebody better, was absent from the first day, and everyone involved knew it. What replaced that discipline was a regulator. And a regulator setting prices for a notional efficient company, while real companies were free to finance themselves however they chose, was never going to be an adequate substitute. It was outnumbered, out-resourced, and structurally behind, for 35 years. So the question worth carrying away isn't whether privatization is good or bad. It's narrower and much more useful. When something is sold that cannot have competitors, what is actually being sold is the right to charge people who have no choice. And the value of that right is not what it produces. It's how much can be borrowed against it. That is true of water. It's true of any regulated monopoly. And it's the calculation that was never really made in public. In 1989, when the government wrote off the debts, printed the prospectuses, and invited the country to buy shares in its own water. The pipes are the same pipes. The rain still falls. 16 million people still turn on the tap in the morning and it still works. The only thing that changed is who holds the claim on what they pay for it, and how much has been borrowed against them in the meantime.